Hello, everybody. It's Monday, May 18th. How time flies when we're having so much fun. However, it's not 11 a.m., which is the time I usually do these things, but it's midnight. It's 12:01 a.m. on May 18th. And the reason for that is pre-recording our webinar. I have another commitment, family commitment, for this morning. So I figured we'd spend some quality time together this evening, and well, there won't be a Q&A. You can always send me a email if you have any questions, but I'll try to cover quite a bit of information here with charts and so on. Look, very interesting times we live in, obviously. We've had the stock market hit an all-time record high on Thursday of last week. And then Friday, the market was down. The S&P 500 was down 1.2%. And I guess ever since then, over the weekend anyways, from what I'm reading, people are kind of freaking out about the sell-off in the stock market, even though we were at a record high just on Thursday. But the concern is really the sell-off in the bond market. Bond yields have been rising around the world, including the U.S., for several weeks as a result of the Gulf War and its impact on oil prices, which then has had an impact on energy prices and CPIs. And there seems to be some indication in at least the U.S. PPI that these inflationary pressures are spreading beyond just energy and are creating another inflation problem the way we had back in 21 and 2022. And it's certainly something that needs to be considered. But I would also point out that it's very interesting. I don't know that it was a coincidence, but Friday was the first day that Kevin Warsh checked into his new office at the Fed as Fed chair, the new Fed chair. And as we all know, Kevin Warsh has been pushing the Fed to lower interest rates. Now he's in a position to perhaps do that now that he's chair of the Fed. And the bond vigilantes are basically disagreeing with that kind of viewpoint. And I think people have been asking me, don't the markets always test a new Fed chair? And I guess the answer is yes, they do. And this time around, it's the bond market that's doing it. So my friends, the bond vigilantes, aren't predisposed to believe that the right course for the Fed is to lower interest rates here. Clearly, they are pushing for higher rates, and they're kind of taking charge here. The bond vigilantes have always had this attitude that if fiscal and monetary policies aren't going to maintain law and order in the capital markets and the credit markets, then they'll do so. And so the bond vigilantes are basically pushing Warsh to join the tightening camp here, which we started to see in the April FOMC minutes. There was some indications, and we saw it, well, it was more than that in the statement. We saw that while Moran once again dissented and voted for a rate decline, there were three dissenters that wanted to get rid of the easing bias in the FOMC minutes. And now it's pretty clear after what we've seen in the CPI and the PPI and the relatively strong economy. The latest estimate from the Atlanta Fed is the economy is actually growing at 4%, real GDP at an annual rate. Now that may come down, but that's what it looks like right now. I know retail sales looked weak, but the control group was relatively firm, and it was one of the reasons that the Federal Reserve of Atlanta's GDP now model was revised to the upside in terms of real economic activity. So the labor market also looks pretty firm. We've had a couple of months where the employment numbers have been better than expected. Initial claims remain low. So clearly the risks of in terms of the dual mandate, the risks of rising unemployment has actually gone down, while the risk of inflation has clearly gone up. No wonder there were three dissenters in April saying that they wanted to get rid of the easing bias. Now, undoubtedly, in the June meeting of the FOMC, I think just about all of them all of the participants will be pushing for getting rid of the easing bias. And I don't think they're going to want to go just from there to a neutral stance. I think they're going to go straight for a tightening bias. Question is, what will the new Fed chair, Kevin Warsh, do? I don't think at his first meeting he wants to be the only dissenter. I think Moran's gone. Moran is moved on, and so the only kind of Trump influenced or Trump supporting Fed official now is in fact Kevin Warsh. But does he really want to dissent and say that, hey, no matter what we see in inflation, no matter what we see that the economy is doing, productivity is going to make a big comeback here. The AI revolution is the real deal. That's going to lead to lower inflation. And the Fed, therefore, should be anticipating all that and actually lowering interest rates. So just ignore all that noise that we're going to see for the next few months of higher inflation. Now, as you know, we're still in the roaring 2020s camp. We're still big believers in the productivity stories. We still believe that productivity will keep a lid on unit labor costs, and that'll help to offset these inflationary pressures. But meanwhile, that's nice that we share that view with the Fed chair. But his job is to maintain the Fed's credibility relative to what the markets are concerned about. And right now, the markets aren't focusing on our roaring 2020 scenario, which has worked very well for the first 7 years of the decade. But along the way, there have been stress tests. And right now, the bond vigilantes are providing a stress test of the roaring 2020 thesis. They are concerned about stagflation. They're really concerned about inflation more than a stagnating economy. A stagnating economy doesn't usually bother them, but they are concerned that Warsh is in a position of influence. He's the Fed chair, but it's very, very unlikely that he's going to have any influence on changing the Fed's course here. And the Fed's course here is going to be dominated by what the bond vigilantes are pushing for, which is don't even bother going to neutral at the June meeting. Go straight for a tightening bias, if not an actual rate increase. If the Fed were to provide a rate increase at the June meeting, that would be a total surprise to everybody, but it might actually increase the Fed's credibility and bond yields might actually come down. So the Warsh paradox might be that if Warsh does the complete pivot and says under the circumstances, we really do need to move to a tightening bias, not only that, but he supports actually tightening rates in June, the bond market might be very impressed with that and bond yields might actually fall. But I'm just speculating. I'm just talking out loud here about what could happen. The most likely development is in June, there'll be a move to a tightening bias. And at the July meeting, there'll be a rate hike. I don't know if there'll be more rate hikes after that. This is a very fluid situation. There could be. But then again, let's see how the oil price plays out. Right now, the war is still on. The ceasefire is still on. The blockade of Iran is still on. The blockade of the Strait is still on. And yet the remarkable thing is that the oil prices aren't a lot higher. And maybe part of the answer is that, as I've said before, Russia is probably selling a lot of oil to China and India, maybe to other countries, one way or the other. The U.S. is exporting more oil. Venezuela is selling more oil. And maybe most importantly, the Chinese economy looks actually pretty weak. We just had a batch of economic indicators come out for China, and the retail sales numbers were very weak again. So that might be a good fortunate development in keeping the price of oil from zooming much higher. Why don't we have a look at some charts here? My basic view is I'm still arguing for 8,250 on the S&P 500 by the end of the year. I think that we may very well move sideways, even have a small pullback following the sell-off on Friday. I think the bond yield is at an important level here at 4.60%. If it goes higher than that, it'll probably be get up to somewhere between 4.75% and 5%. I think that would be a pretty good opportunity to buy bonds and stocks. And all that could play out pretty rapidly, as we've seen in this recent pickup in the bond yield. Well, let's go to the charts. Let's first start out with the morning briefing charts, and that's the morning briefing is titled Bond Vigilantes Welcome New Fed Chair Warsh with Loud Bronx Cheer. I mean, what else can I mean, that kind of that kind of says it all, and I think it's fairly accurate. Friday he was his first day, and we saw bond yields jumping. Take a look here at figure one. Let me make the chart a little bit bigger. There you go. So we saw this the 10-year bond yield jump from 450 to, well, it was actually lower than that. Now it's up at 459. So you can see we had a big jump here. I guess back here it was more like 440 or so. But it was a big jump in one day. And then the 30-year jumped to 512, which is the highest it's been in quite some time. The 2-year note yield, which is a pretty good indicator of what the fixed income markets think the Fed's going to do next, well, that rose up to 4.09%. I think tonight it's up to 4.1%. But you could see that when the 2-year was going up, that was a good leading indicator for what we saw happen with the federal funds rate. And then the 2-year was below the federal funds rate, signaling that there would be a decline in the federal funds rate, as there was. And then it's only recently that we've seen the 2-year rise above the federal funds rate range, which is 3.5% to 3.75% right now. And so the 2-year is clearly saying that that's too low. It needs to be raised, as is the bond yield. Meanwhile, this is not just a U.S. phenomenon. We're seeing bond yields going up around the world in the major developed economies. China's kind of the outlier, but everybody else, Japan, Germany, France, US, UK, we were all seeing bond yields going higher. So it clearly reflects concerns about fiscal deficit excesses, but more than that, it reflects concerns that inflation, we're getting a second wave of inflation comparable to what we had in 21 and 22. Back then, we had significant demand for goods. We had significant supply chain disruptions, and that kind of was the first trigger for inflation. And then we had an oil spike when Russia invaded Ukraine. We also had a wage price spiral. What's different this time? Well, arguably, the supply chain disruptions are more limited, though maybe more serious in terms of oil being a rather important commodity. There are issues with fertilizer, perhaps. The helium thing, I think, has been overdone. Looks like there really isn't going to be a shortage of helium, which is necessary for production of semiconductors, for example, and for running MRIs. Uh, but this time around, I don't think we're going to see a wage price spiral. The supply chain disruptions are different from what we had last time, but maybe still significant. But we also have an oil price spike as we did back then. But this oil price spike may be more troublesome because of the Strait of Hormuz blockade. Anyways, the UK has had all kinds of uh, political concerns about the government being too lax with its budget. And in addition to that, they have an inflation problem. Germany, same story. German yields have gone up. Japanese yields have gone up significantly. So it's been a global phenomenon, and to the extent that yields go up overseas, that puts upward pressure on yields in the U.S. because foreigners tend to be big buyers of U.S. securities, but less so if they can get decent yields at home. Let's move on here a little bit. So here we have an inflation problem. The CPI wasn't all that bad. The PPI was bad. As you can see, this is the PPI, and it is kind of reminiscent of what happened here, where the PPI took a jump up. There were signs that energy inflation was spreading to some other areas of the economy. It was widening, becoming a widening problem, and undoubtedly this will lead to a higher CPI and PCED. I don't think we're going to be looking at this kind of situation. I think, but I mean, who really knows? I mean, it's going to depend on what happens in the Strait of Hormuz and the extent to which Russia meets some of the shortfall. The U.S., Venezuela, other oil-producing countries might meet the shortfall. China might see less oil demand growth because its economy is weakening. Um, Here's another take on the inflation problem. This time it's on a core basis. Same story. Core inflation is up a lot for the PPI, and that's a harbinger of more trouble for the CPI and the PCED. Meanwhile, it's true that we don't have a wage price spiral, but I guess we could. Baby boomers are retiring very rapidly. As you can see, this is people who are not in the labor force, 65 and older, as a percent of total not in the labor force. And so you can see that the percentage of people dropping out, baby boomers, is increasing rapidly. So that reduces the supply of labor. Meanwhile, the immigration restrictions also reduces the supply of labor, and the demand for labor seems to be picking up somewhat. So that could be something to watch. So we'll be watching average hourly earnings for all that. Right now, they seem to be relatively tame. So no concerns for a wage price spiral now. And again, that's a big difference from what happened in 21, 22, right? Labor market was much tighter. It was much greater demand for labor than supply back then. And so we had a wage price spiral. That's not likely this time. We do agree with Kevin Warsh that productivity is going to continue to grow at a faster pace. That should keep a lid on unit labor cost inflation. Unit labor cost inflation in the first quarter, year over year, was down to 1.2%, and that should offset this inflation should offset some of the inflation, at least on a short-term basis. We also have the owner's rent inflation that's moderating. So yeah, we have an inflation problem, but it's not of the magnitude of 21, 22, and that could keep Warsh kind of pounding the table on let's look through all these short-term inflation problems and recognize that once they settle down, the economy is not going to have an inflation problem. So why not stimulate the economy to get more productivity? Again, we're sympathetic with all that, but we don't think the economy needs lower rates. We've said that really for the past couple of years. Fed wouldn't listen to us, and we were wrong. The Fed went ahead and didn't listen to us. They lowered rates, but we were absolutely right that the bond vigilantes wouldn't buy into it, and bond yields actually went up. So that's what's been happening. Again, labor market is in equilibrium. Back here, we had demand a lot higher than supply, so very prone to a wage price spiral back here. Um, What else? Fed funds rates come down. The 2 year says that the Fed funds rate should go up. We're not quite seeing that in the futures market. The federal funds futures market is more like no rate hikes or cuts over the next 6 to 12 months. But we're going to go with what the 2 year is saying. Meanwhile, the other thing that the Fed needs to factor in is and puts a lot of weight on is the inflation rate, the expected inflation rate, and not much signs of trouble yet. When you look at expected inflation from the Federal Reserve Bank of New York Consumer Survey, you can see that April is 3.2 for the 3 year and 3.0 for the 5 year. So that doesn't look like that looks like inflation is still well anchored. And I guess Warsh could say, what's the rush to raise rates if inflation's still anchored? Expectations. If you look at the consumer sentiment survey, the 1 year is at 4.5%. But again, the longer term is at 3.4%. But that's still kind of high relative to where it had been back here, which was closer to 2.5%. And then market anticipations of inflation have been increasing, whether you look at the 10 year US Treasury yield minus the 10 year TIPS yield, or you look at the 5 year forward inflation linked swaps. Um, the rest is about the consumer. There's a couple of reports that came out on the consumer and basically confirmed that nothing, nothing, there hasn't really been much change over the past year in either the balance sheet viability of consumer spending or some of these credit issues with regards to delinquencies. Now let's take a quick breeze through the quick takes. And the quick takes, the market call is titled "Time for a Break or a Break." So a lot of ambiguity there. Is time for a break could be a time for the market to just take a break from going straight up, or it could be mean that after going straight up, it's time for the market to take a break, or so on and so forth. Anyways, we're in the market probably is going to pause here for a while and could have a pullback. Um, I don't know that it'll be comparable to what we had earlier this year. I think a lot of people would love that because there's still a lot of people who agree with us that there's a that the future looks pretty bright for the U.S. economy and that any sell-off is probably a buying opportunity. Anyways, we're at the top of the pack here in the latest Bloomberg survey of street strategists. Um, and you can see that we're looking for 8,250. Here's some of the other bulls. Morgan Stanley, which typically has had sort of a bearish bias, is up there. So honestly, I'm a little concerned about that. Um, but other than that, you can look at it on your own. The average is 76.12. We did get to 7,500, and we were looking at 7,700 as a year-end target, and a week or so ago raised it to 8250. on basically the results from the first quarter earnings and all the upward revisions and expected growth for earnings over the rest of the year and into next year. Well, on the other hand, we still have an oil problem. We had one back here. You can see that we have a similar one. We're not quite as high, but we're high enough. And we're, jumping around here the way we did back then. And I think we can expect that this will be coming down one way or another. I mean, oil is a commodity, and the best cure for high oil prices is high oil prices. And there could be some demand destruction, maybe in China and India. I don't know that the U.S., I don't know that $5 gasoline is going to really cause a lot of people to drive less. Could, I suppose. But the other thing is, I think we'll be surprised that, I mean, oil's fluid, and fluids can flow around, and one way or the other, oil may very well get out of the Middle East and come out from other areas to meet demand. And I think the U.S. So I don't know that I don't think we're going to see 125, 150, 200, even if the strait remains closed. If it does remain closed, I think we're going to stick around 100. I think the U.S. economy can handle it better than other economies. Meanwhile, it was just Wednesday of last week that we looked at this chart and told you that it was around here. We told you that it could get up to 460. Well, it did it by Friday. And now, if it does break through to the upside here, 4 3/4 to five is possible. At five, the Treasury will probably play more games and issue more bills and fewer bonds as it did, I think, when we got here. Yeah, remember that was in 2024. We got up from 4% to 5% in 3 months. And Janet Yellen right here announced that the Treasury needed to raise more money, but they do it in the bill market, not the note and bond market, and that helped to bring the bond yield down. But so did lower than expected inflation. This time around, we have more of an inflation problem. You can see here the forward PE versus the bond yield. You'd expect that if the bond yield goes up, the forward PE would go down. That could be another reason for some pullback in the market. But then again, we have had the bond yield going up and the PE going up. So on a short-term basis, they can. It doesn't have to be that when rates go up, the PE goes down. Meanwhile, the equal weighted S&P 500 really didn't break out to a new high, and it didn't go up all that much above its 200-day moving average, the way that the S&P 500 market cap weighted index did. So this has more potential for a pullback than this one. This is more like reflecting the S&P, let's call them the impressive 493. And it's conceivable that the market would kind of go sideways on some correction in the Magnificent Seven and AI-related trades, while the other impressive 493 hold their own because we are seeing expansion of earnings breadth. Meanwhile, there is a sign of some irrational exuberance here. If you look at the S&P 500 consensus expected long-term earnings growth, look at that. It's up to 21.2. I mean, it's well above what we had when irrational exuberance got long-term earnings growth up to about 18%. Now we're at 21.2%. This was back when the Fed, remember we had the pandemic uh, sell-off here. Well, we had the pandemic bear market here, if you can barely see it. Um, and then the Fed flooded the system with liquidity. The Treasury came in with checks to provide some income support for people, and that obviously sent expectations to the moon here. And a lot of that was the Magnificent Seven. Then it came right back down here during that uh, bear market we had in 2022, then shot right back up, and now we're here. So, is this irrational exuberance? Yeah, to a certain extent. And the question is, do we need to have a bear market to correct it? And not necessarily. I don't think so. Why? Because the earnings story is still very strong. Forward earnings, all-time record high, did kind of edge flat in the latest week, but the earnings reporting season is over, and the earnings reporting season led to significant increases in expectations for earnings for 2026 and 2027. This is the quarterly numbers. The quarterly numbers for this year are all in the double digits. So obviously the first quarter surge led to that kind of expectations that that'll continue. The earnings breadth measures that we have, they all look quite good. So that kind of supports the possibility of this market has been a relatively concentrated market since March 31st when the market took off. And now maybe we'll have some correction in the leadership, the thin leadership, and just kind of a broadening out in the breadth, or at least the rest of the market will hold up. This is another reason to be optimistic. Earnings expectations are not up just for the S&P 500 at a record high, but also the S&P 400 and S&P 600. We did expect that the Magnificent Seven would underperform this year. They did so until the war broke out and until the market sold off. And then since March 31st, they've outperformed. And now maybe it's time for them to underperform for a little while. With regards to pullbacks, we're not seeing the kind of sentiment indications for a pullback that we had seen earlier this year when we anticipated a pullback. This time around, the bull-bear ratios are not signaling that there are too many bulls out there. And now I'm sure after Friday, when we get the next bull-bear ratios for this week, they'll probably be down. So that's an indication that we're probably not going to have much of a pullback in the market. This hasn't worked out too well for us. This is the stay home versus go global. We got this right, but in other words, staying home versus go global, we've been that since 2010. But now in 2025, go global worked. In late 2025, we thought maybe we'd go with that. But now with the war, with oil prices, the U.S. Seems to be in a better position than Europe and emerging markets. So this has stopped working for us, and the stay home may outperform for a while longer. But we still think better valuation multiples, and I think once the price of oil starts coming down again, we'll see this working again. Go global should outperform. People ask us to update on gold. Gold, we're now shooting for 5,500 by year end. Obviously, higher interest rates aren't going to be helping gold very much. A stronger dollar as a result of higher interest rates and higher oil prices. That's not going to help gold very much. But you can see we're right now still on an uptrend, and with let's call it a correction in the gold price. Let's see how it does around here. Look, I've told you that I'm not claiming to be much of an expert on gold. When it crossed above 2,000 to a record high a couple of years ago, I said that it's probably going to continue. It's probably going to be in a bull market because central banks are buying gold. And then I added some other nuances like Chinese investors buying gold, Indian investors have had a long tradition of buying gold. All seemed to work out pretty well. And then it stopped working. It did get to 5,500, yeah, close to 5,500. Now it's more like 4,500. But I'm going to stick with 10,000 by the end of 2029 on the idea that if I'm right about the roaring 2020s, taking the S&P 500 up to 10,000, that rebalancing will provide funds to go from the stock market into the bond market and into gold, maybe some other assets as well. So that's it. That kind of covers what I wanted to share with you today. Take a look at the quick takes, take a look at the morning briefing, and we'll do the best we can to keep you posted on our thinking with quick takes. We're going to get NVIDIA on Wednesday. Maybe NVIDIA will save the day. Um, Other than that, it's a pretty light week for economic data. So I guess we'll all be watching the price of oil for some guidance of where things are in the Middle East. And again, the other issue, of course, is the bond market. And the faster the bond yields go up, the more that's going to put downward pressure on stocks. But the sooner that'll create a buying opportunity in bonds that'll bring bond yields back down the way it did in 2024 when we got to 5%. And that could set the stage for a rebound in the stock market. So that's it. Have a good week, and we'll catch up with you along the way. Thank you.